Hello, everyone. Welcome to today's session. Let's jump right into it here and start out with market conditions. Top-down approach. Remember that the top-down approach is we're looking for what is the market doing in the long term as well as in the short term. A couple of indicators we can utilize to do that is on the directional alerts tab, looking at S&P 500 over the last 20 years and looking at some of the momentum shifts and trend changes as they've been happening. The last one happening a couple of years ago back here at the bottom of this, kind of this COVID bear market, this retracement starting to continue to move higher. And really, we've now had this big, nice run up, the AI run up, the inflation or lack thereof run up, and the anticipation of interest rates coming back down again. Had a pretty nice run here. Productivity in terms of perspective utilizing AI, and markets have had a fantastic run here. We're seeing the upper end of that trend, though, the momentum range now at 26, or it actually is starting to curl back down now a little bit, 25.63, and starting to see that flatten out. That'll happen when the market is having these ups and downs in a range, the upper end of the range. We'll look at that a little bit closer. Buy-sell ratio is back to 2.2, so a solid buy-sell ratio. That was a little bit of a data blip there yesterday that's still updating, but in terms of today, we're looking at that. Still have good positive breadth. Another place to find that is right here on the sectors tab. That buy-sell ratio is 2.2, meaning that for every 2 buys in the database, there is 1 sell. So 2 to 1 to the upside, or 2 to 1 bulls to bears. Another way to look at it is this number here, 2,500 versus 1,100. And remember, it doesn't include the holds in this range. And so just giving another indication of market breadth. What is the percentage, or what does the overall market breadth look like? What kind of participation are we getting? We know that in the indices, we've got Russell, really all the Russells, 2, 3, and 1,000, which are your small and mid-cap companies, are leading the charge right here. So we've seen a big run into more risky assets. The small and mid-cap company stocks are considered a little bit more risky just because a lot of times they're maybe not established, or their revenues are not quite as predictable as larger established companies, and they can also be very fast-growing companies. And so the opportunity for more high reward to risk scenario can unfold in these types of names. S&P 500 getting close to that breakout pattern here, right around that 600 area, solidly into that buy zone, but not extreme. And that's what we want to see as we're seeing trending moves continue to go higher. Is not a lot of volatility to the upside or the downside. We've seen this support area now on S&P 500 holding up and now propelling this direction with some demand. So we'll see if we get additional demand to push us through this area referred to as a breakout. A breakout is just an area where there had been some resistance, and oftentimes that will create, if there is a big group of sellers that are sitting right here, institutional sellers, then they will sell at those locations at a more of a premium price, where they're looking to sell into the strength. If the buyers can break through that bearish selling activity and create additional demand to that upside, then you get short covering, you get additional buyers that are lined up right here to kind of push things higher above those levels. So a breakout trade creates additional buying because you're getting those that are either stopping out of a bearish trade. Remember, if they are bearish, in order to cover a bearish trade, you have to buy it. If you sell first, you have to buy second. So oftentimes buy stop orders for short traders are set up right here. And you also have shorter term traders that'll set buy orders at the top of this range for a breakout trade. Okay, they're just looking for, once the move breaks higher than that buy order, they set a limit order up above the price. If price is right here, you can set that limit price to say, if it hits this price, then I want in. And so you get both the stop outs and additional buying that pushes price through those areas. So the other side of these resistance areas can create quite a bit of demand if it can push through that and essentially break through all of the sellers that may be lined up at that location. So breakout trades create some good continuation. And if there's additional demand there, oftentimes that'll continue to push that even higher. S&P 500 right at that area that could be getting ready to push through a breakout. Sometimes you do get those capitulation breakouts though, where it pulls in all of the latecomers and saying, oh, okay, market is finally in an uptrend or continuation of that uptrend, and you get additional buying, and that additional buying can create liquidity for more selling. So it can kind of be a double-edged sword, and you start to reach these new upper highs, particularly when we've had such a long bull market now, within the last 18 to 24 months. If we take a look at the bond market, let's take a look at that bond market and see what's happening here. We haven't looked at that for a little bit. The 6-month time frame, we did see bonds yesterday. The TLT, which is the long-term bond, have a big run up here. Remember, when bonds are moving higher, then interest rates are moving lower. So if we have a push higher in bonds, and that's been part of the issue as bonds have been moving this direction really since September, October, interest rates have been dropping, interest rates have been climbing, even though the Fed has been lowering rates and the anticipation is for them to continue to lower rates. The bond market has not been the case. So there's a little bit of disconnect happening there, but we're seeing a pretty big nice pop right here yesterday for some potential continuation on that. SHY, also the short end of this yield curve, right around that 82, finding support around that retracement zone at the 618, which is kind of the bottom end of that corrective zone. When you have this range here and you've got your trending direction here and it's pulled back about that 50% or that 618 range, that can be an area where nobody's left to sell. Okay, there's no more sellers left, and demand. Buyers start to step back in these locations and start to push back up again. You get these areas of imbalance, and this creates new potential demand. And when it holds up right here, you can see that there is some pressure to the buy side. We are getting more demand starting to come back in. That could be good for stocks as well if the bond market believes interest rates can come back down, that the economy's fine, that inflation is under control, and that could also bring interest rates back down a little bit. Let's jump over to sectors. Sectors, we saw pretty nice confirmation really across the board here, everything in short-term uptrends and almost everything back into that buy zone. So you're getting momentum across the board now on all of these sectors. Commodities, gold had been making an attempt here. Let's take a look what it's doing today, and it actually has bounced pretty significantly off of some of these lows and moved back up to that 250 range, pulling back into that corrective zone still. So gold's still in that downtrend zone. SLV, the same thing, attempting some support, and then I believe we also have USO, which is the oil ETF, doing the same thing here to the downside. We may have a little bit shorter session today. I've got a couple of things that I've got to run to here in the next 10 minutes, but let's continue to go on here. Again, that's the top-down approach. Part of the reason we go through this process is as you're looking for opportunities and looking to say, where is the market at? Are we in a downtrend? Are we in a bull market? Are we in a bear market? Are we at the upper end of the range? Are we at the lower end of the range? Are we deep into momentum? Are we consolidating and starting to move lower? Are we early in momentum, or are we bearish and moving back up the other direction? The advantage of that really is essentially, how am I allocating my risk towards those market conditions? Do I want to be 100% invested in equities, or do I want to be, some other allocation? And the upper end of this range, currently, the portfolio, now there's lots of different scenarios you can have. The upper end of the range, I've been managing this portfolio to be around 25% allocated, with about 2% position size per holding. Okay, so each of the holdings are about 2% of the entire piece of the pie, and the bulk of that is in cash right now. That's just my preference for the risk tolerance for this portfolio and where the market is in this cycle. Cash is still paying pretty well, and it's a relatively conservative approach. You can be more conservative by adding larger positions instead of 2%. Okay, instead of 2 to 2.5% allocation, maybe you jump that up to 3%, 3 to 5% of your holdings, and One of the other things that we do to manage the trades here is we will sell some of the position on the way up. So when we add into a new trade and it's starting to move higher, we'll typically sell once the stock has increased by 20%. And again, on your trading plan, you can adjust this. Let's say you want to exit some of them a little bit sooner. You could take it at 10%. But at 20%, we will sell 25% of the position. So if we have 100 shares on the way up into the strength, we're going to sell 25 shares, 25% of the 100 shares if they get to 20% a gain or not. Then that leaves us with 75 shares left. So we're selling some into the strength, and then we've got the rest using a trailing stop. When they get to 50%, we'll take another 25% off the table, and then utilizing trailing stops on the remaining amount of shares. That's the double-edged sword of portfolio management and trading as a whole. Is the buying and selling process. Very seldom, if ever, do most traders pick the exact bottom and the exact top and the exact right trade, the exact right stock that's going to move higher. And so we're looking for the edge that we're focusing on is we're focusing on these momentum style stocks. We're looking for stocks that are already strong. Let's look at this stock here. They're already moving in uptrends, and they've gone through some kind of a retracement, some kind of a pullback, a pause. Stocks are just, think of it like a sprinter where they're really sprinting. You get all of this demand all at once. It takes some time to rest. There's not going to be a ton of demand all the time that's going to push it right back up. You're going to get some sellers. You're going to get some traders that are in there. You're going to get some profit takers that are in there at the top end of a move, but it doesn't necessarily mean the overall trend is over. It has some kind of a pullback or a retracement, and so we can use these Fibonacci zones as areas to be aware of the depth of that retracement. And typically a momentum style stock will stay above or near this 236 location. This has been a pretty aggressive, volatile stock, may dip down a little bit deeper, and it can still be in an uptrend all the way back down into these locations. 50% retracement just means that from this low point that it's connected, and the reason it's connecting to this point is because we're just looking at the 6-month time frame. Okay, we're just looking at that time frame, and so it's grabbing the highest point and the lowest point on that chart, and then it's drawing out where are these retracement locations. So this is saying this is our trend direction. This is saying these are levels of the current trend direction that the price should find support at and still be in an uptrend. So ideally it retraces. We find support here, it goes higher. If it breaks through that and goes down to a deeper rung in that ladder, it may find some support here and then move higher. It may find some support here and then move higher. Or a really deep retracement is all the way back down here and then it moves higher. So you're getting, really three different scenarios, and you're getting one where you have a continuation trade. The stock is in momentum. There's demand there. There's buyers lined up and ready for any pullback. These deeper retracements can get, a little bit more institutional, bigger sellers, more sellers. Maybe there is some news. The anticipation of the excitement of whatever drove this stock higher maybe is gone or removed for some reason. Maybe an earnings report or some kind of an announcement of some kind that changes the perspective of the growth scenario of that stock. Remember, anytime a stock is going higher, it's based on either the company earning money, the company's earnings growth, or the company anticipated to earn money, to make money, and to grow. It's nothing else. Okay, there's no other factor that's going in. There may be other factors, but those factors ultimately are around or a part of, is this company going to grow, and at what pace is it going to grow? And the stock price is a reflection of that potential growth. Now, it may not be growing. It may be losing money, but the stock market might be saying, we believe in their product, we believe in their idea, we believe in their management, we believe in their pipeline. They've got a good pipeline. They've got all of these things, and we believe that they will make money because of all of the structure that is there. And you get investors and traders that'll buy into the idea of the stock making money. Ultimately, the stock has to make money. I say the stock, I mean the company has to make money, or the stock is going to collapse. Okay, bottom line, just doesn't work that way for very long. The company has to do what the expectation or the anticipation is, and then when you hear of, when you hear of an earnings report and they say they beat expectations, well, there's always an expectation in anything, in the stock, in the earnings, in the anticipation of growth. There's always anticipation, okay, or the expectation, and when a company beats the expectation, then there is a rebalance. And typically, if it's an earnings report and maybe they give their earnings report before the market opens, and they earned, instead of $100 a share, they earned $200 a share, and so the market was surprised by that, and then you see a massive gap higher, and the stock gaps way up because now there's more information that is known. It was only anticipated to that point, and then once the information is made known to everyone that can invest, you'll get a big spike up, or if it was bad news, you get a big spike down, or it doesn't always have to be a big spike up. That's just in the case of really, big expectation, big guidance moves higher, or expectations missed to the downside as a company is growing. But ultimately, what we want to look for is, we're not interested in, the vast majority of time, we're not interested in the trading process of this stock, buying here, selling here, buying here, selling here. What we're more focused on is the longer term trends within that overall uptrend. Okay, and in this case, that's about the typical time frame. Is about a longer time frame is about 6 weeks, 8 weeks, because the stock will trend and then it'll go back to a non-trend. It might even go into a potential downtrend, but ultimately recovers and comes back into this trend. So when you're looking through the charts, the scans are all built out to pull in these kinds of names. So the new buys are going to have stocks that have gone from a hold to a buy. Okay, and you get these patterns here: hold to a buy, increased volume in the upper momentum zone. So all of the new buys, you'll notice that's what we're looking for. And that's what we want to look for. Okay, we want to look for stocks that are doing this. Here's an example of, and this is today. So this morning, this is a 97 rank. This morning, you'd be looking at this bar pattern and saying, I went from this hold into the buy, big volume. It pulled that into the scan. And now I've got to say, should I be buying into that trade or not? In this case, it would have been a good scenario because the stock is continuing the overall move higher. And so we're looking ideally for this range right here. When we get to this yellow and this red phase, we don't want to be in the stock at that point. Okay, 2020 hindsight is a beautiful thing. Okay, nobody knows the future, whether they tell you they do or not. Nobody does. No one knows what a stock is going to do. Maybe some insiders do, but the vast majority of time, nobody knows. Even with that information, no one knows how that information might trade. And so, instead of saying, I should have bought it here, and buying it here is, I'm too late, so now I should be selling. That's not how momentum stocks work. Momentum stocks, once they get that momentum and you're starting to build out, then this could be the very early phases of a new longer term uptrend. Okay, and so we want the edges that we're looking in this location of the chart. We're looking in this upper quarter of the chart. Okay, there are opportunities in trades on these pullbacks. It's just a slightly different methodology because we want to focus on the fact that there is some evidence. There's evidence of demand. And sometimes that creates a range that may be too high for us to establish a risk location, because we want to use that evidence of demand, that evidence of buying interest, as our risk parameter as well, to say, okay, if I'm going to buy the stock right here at the open, I would say, at what point, how much am I willing to risk onto this trade? And I've got to decide at what point on the price chart it may be an area that, it's going to move lower, and ultimately it's like, I don't know what's happening now, and I don't know why it's moving lower, and very seldom will you ever know why it's moving lower. That's why markets have both a buy side and a sell side, because there's always two sides to every trade. And we're just looking for the bullish imbalances. We're looking for more interest in types of companies that have this possibility of growing significantly and quickly. Okay, a lot of times they're pretty small, 285 million market cap. That is a small cap stock, probably a micro cap stock, very small, very volatile, but there's opportunity there because it's just getting started. they may be looking to compete with some of the bigger players that don't have the ability to be nimble. They don't have the ability to move. And so these kind of companies get bought out all the time by the big boys. And so, or their technology does, or they just flat out create a new market niche that really takes off. And that's happening a lot right now, particularly in these spaces where we're seeing semiconductors, electronics, chips. With the demand that NVIDIA is having, you better believe there's going to be competitors that come in and say, oh, we want to compete because NVIDIA owns the entire GPU world. There may be companies that come in and compete. So the fact that there's huge demand in certain areas, that's where the easy money is. And for companies that have the ability to create or compete inside of some of those same markets, they may do so. Also because they may be looking to say, hey, we want to get bought out by NVIDIA because we're able to create additional value for what they're trying to do. All of those things. That's just kind of the conjecture behind why stocks move. Ultimately, the basis of a price chart is that there is interest, there's demand, there is volume. It's moving higher once it gets to that upper range. So even now, this is not too late to look for a setup on a trade like this. Even though it's running into some resistance, and maybe you have a little bit longer time horizon, maybe you go a little bit wider. Remember, the two levers that we're pulling are stop loss and position size. So if I said I want to buy position of this trade, and I want to come in and I want to buy 100 shares, what percentage of my overall capital that I'm allocating towards this kind of a stock trade is on the line? 4% if I go, 1,000 shares. Let's cut that down. Let's go 500 shares. So 2%. So this is that 2% that I'm referring to. And this is specific to your own trading plan. It's just a starting point to say 2%, 2.5%, because it allows you to play in some of these names without having an extreme gut-wrenching volatile experience, because these stocks will have that. If you have $10,000 and you put $10,000 into a stock like this, you might double it or triple it in a short amount of time, but you also might lose 50% of it in a short amount of time. Okay, so the position size is protecting you against the volatility of that stock. And there could be volatility for a million reasons. It could be market volatility. The market just retraces or pulls back. It could be individual stock volatility or risk because something specific is happening to this company and it's affecting the stock price. Volume is pretty big, 3 million on that. So a decent setup, for this kind of a name coming in. Now we also want to set our stop loss. Now we can do that a couple of ways. You can come all the way back down to this low point and say, if this stock were to come from here all the way back down to this certain point, something's happening that I don't want to play. I don't want to wait around and wait to see ultimately what is happening and potentially turn this loss into a bigger loss. Okay, so what we're doing with the risk management is we're saying, how much risk am I willing to take? Or in other words, how much could I potentially lose on this and be okay with it? It was a trade. I realize there's risk, but I'm taking a bet on this capital that it's going to go higher. If it doesn't go higher, what is my risk in terms of dollar figures? If I set a stop at 345, that stop goes to 345 here. That puts me at 0.69. Okay. Inside of this portfolio, that's way too high. I want to be right around this 0.3 number. Okay, 0.3 to 0.2 number. 0.7, okay, that's $800 at risk. That's 32%. Why? Because it's basing it on this number that we're buying it here. And my stop loss is all the way down here. If we would have bought this in the morning, let's say it's 430. Okay, current value right here, 430. That changed it a little bit, 0.36. Okay, so that actually could have potentially been a reasonable. Even if we set our stop loss right here to 375. Oops, 375. So pre-market at the market open. Before this one opened, we could have bought at the market open with a stop loss at 375 and been inside of our trading plan number here at 0.23, less than the 0.3. That's $275 at risk on an approximate $100,000 portfolio. Okay, that's one of the ways to be able to look for your edge, meaning I'm looking for these kind of companies that have a high probability of continuing the move higher with demand. and price activity confirmation. Okay, the reason why price goes higher so much faster on these big demand days is because I explained it the last time. Is if I have a big buyer that has 100 shares and they want to buy it, and there are 10 shares here for sale, 10 shares here for sale, 10 shares here for sale, and 100 shares way up here for sale. These guys are going to buy that 10, they're going to buy that 10, they're going to buy that 10. Well, what does that do to the price? It pushes the price higher, and ultimately at some point, they're going to say, okay, now we hit 30 plus the 70. We bought 70 shares here, and there's 30 shares left. Okay, and that's maybe starts to slow the buying down a little bit because this big buyer now is completely filled on their order, and their order took out. They basically bought all the shares available from all of these buyers along the way up, and they were willing to do that. They said, I don't care what the price is, we're just going to push it until we run out of shares. We're buying our full shares. Now 100 obviously is not going to do that, but if it's 1 million shares, then that certainly could do it. And if you have a company that wants in and they want in today and they want in now, then you certainly can see that price activity moving stock prices higher. Okay, so again, the methodology is consistent. It's the same process over and over. It's just a matter of having a different stock. That stock might be it could be General Electric, it could be Walmart, it could be Tesla, it could be Home Depot, it could be you name the company that you know, or it could also be some of these other companies that you may not be as familiar with. The reason why we want some of these names is because their ranking is so high. They're already moving that direction. Okay, Shake Shack, for example, you have a higher probability of it continuing this direction than you do of it completely collapsing and moving the other direction, particularly if it's already shifted trends here. It's shifted trends and started moving back up. The longer it gets into the trend, obviously, the higher probability that it can also retrace there as well. If I were to go out a couple of years on this, let's take a look and see about where that trend is if it's relatively early. So this has had a couple of deeper retracements, some moves higher. They can certainly add into some volatility, but ideally we're focusing on these moves here, avoiding the retracement. While it's red or even yellow, we're not necessarily as interested. Once it starts to turn green, gives us that confirmation. That's where we're more interested in now following that trend direction and following that overall, those institutional buyers as they are pushing the price higher. And in some of these bigger names like Shake Shack and these large cap names, this is a market cap of $5 billion, and that's going to be a little bit harder company to move, a little bit harder stock to move. You've got 1 million shares trading, and you don't get quite as much gappiness and volatility. The trends are a little bit smoother, but not always. But these can be the kinds of names, the rank's a little bit lighter, but still very strong. It's performing very well against its peers during this bull market rally. I'm going to end on that note. Appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.